Welcome to the deep dive. Today, we're peeling back the layers on one of the most volatile yet, I guess you'd call it, highly successful stories in modern tech investing.
You're talking about Shopify.
Shopify, exactly. Ticker symbol SHRP. When you look at the company, over the last decade, the phrase outsized return is, well, it feels like an understatement.
It really does.
Yet, if you just zoom in on the last few years, the ride was terrifying. I mean, a dramatic crash, a big comeback. So the puzzle for us today is this. How can a company with such a solid core business create such wildly different experiences for investors?
Right. And sometimes really painful experiences.
Exactly. All depending on when you happen to buy in.
It's a perfect case study, really.
Yeah.
It's all about timing, strategy, and how the market reacts. So our sources give us the whole timeline from that IPO euphoria all the way to the depths of the 2022 bear market.
And our mission for this deep dive.
Our mission is to dissect the exact moment the company created this self-inflicted wound, the move into logistics and fulfillment, and then analyze the incredible speed with which they corrected it.
So separating the successful software part from the momentary distraction?
Exactly.
Okay, let's unpack this. We should start where the legend was built, right? The long-term payoff. You almost have to anchor yourself back at the IPO in May 2015 to really get the scale of it.
That's absolutely essential context. If you were an investor, say you put $1,000 in on day one, on IPO day, and you just held on, you'd be holding roughly $60,000 today.
Wow.
That's a 60-fold return. I mean, that puts Shopify squarely in that category of, generational wealth creators. It just shows the pure power of their core model.
Which is providing that software backbone for millions of merchants.
Exactly, helping them compete online.
60 times your money.
Yeah.
I mean, that success is why the company keeps its reputation. It proves the fundamental idea works.
It does.
But, and this is the critical pivot for our discussion, that incredible long-term picture, it kind of obscures the recent pain, the pain felt by a totally different kind of investor.
The person who bought into the hype around 2020.
Exactly.
That's right. The core success, which is built on, more than 10 years of growth of market dominance, it can make new investors a bit blind to the volatility that's just inherent in high-growth tech.
So for the long-term holder, the dips are just noise.
Temporary noise. But for someone who just got in, those dips feel existential.
So let's face that recent reality head on. We're calling this group the 5-year strugglers. We really have to dive into the specific math that makes this so frustrating for them. Okay, so our sources confirm the exact numbers. Over the past 5 years, Shopify's stock is up approximately 58%.
58%.
Now, in a vacuum, that sounds pretty decent, right? But the context is everything.
Here it comes.
The S&P 500, the general market benchmark, more than doubled over that exact same period.
And this is where the emotional and the financial reality just hits you.
Yeah.
Hard. If you're a 5-year shareholder, you didn't just miss out on those huge gains Shopify is famous for.
Yeah.
You actually saw an immense opportunity cost. You took on all the risk of a single volatile tech stock.
And got penalized for it.
Dramatically penalized.
Yeah.
You earned less than half of what a simple index fund would have given you.
It's brutal when you put it like that. You accepted the risk, but you got less than the average reward. And timing. I mean, timing was just everything, wasn't it?
Absolutely.
Yeah.
Think about the person who got excited and bought in late 2020.
Right at the peak of the hype.
They would have had a rocket ride that first year. They'd see their position go up 60%, feeling like a genius.
Totally validated.
Then the two pressures we're about to talk about hit. And those gains weren't just erased. The position fell deep into lost territory. The whiplash, that feeling of being a financial wizard one day and then staring at an 80% loss the next, that defined that period.
And this wasn't just, general market turbulence. Our sources point to two big factors that hit at the same time. You had the 2022 bear market, which hammered every tech stock. But you also had this self-inflicted wound, the decision to pivot into large-scale shipping and fulfillment.
And that decision was just fundamentally at odds with their core business. It caused Shopify to just hemorrhage cash. It pushed them from a profitable asset-light model back into big quarterly losses.
And investors hated it.
They absolutely hated it.
Okay, so this is where the analysis gets really interesting. We have to understand why they even thought moving into fulfillment was a good idea before we get to why it failed so spectacularly.
Right.
They're a software company. Why on earth did they decide to become a heavy logistics player, with trucks and warehouses?
Well, the initial logic was competitive.
Oh.
And it was understandable, even if it was flawed.
Okay.
Shopify's whole mission is to help their merchants compete with Amazon. And what's Amazon's biggest advantage?
Their logistics. Fulfillment by Amazon, it's seamless.
It's their ultimate moat. So Shopify's leadership looked at that and thought, we need to offer something similar. They thought they had to control the whole supply chain to keep their biggest merchants.
So they were trying to buy their way to competitive parity with Amazon, but they were, using the wrong tool set to do it?
Precisely. They were trying to solve a software problem with a heavy infrastructure solution. And you have to understand just how different those two models are. An asset-light software model versus an asset-heavy logistics operation.
Walk us through that difference, because this is so central to why the stock collapsed.
Okay, think about Shopify's core business. It's code. Once the code is written, selling that software to 1 million merchants costs almost nothing extra. The gross margins are incredible.
North of 75%, sometimes.
Exactly. You don't need real estate. You don't need union talks. You don't need to depreciate machinery. It's asset light. It's highly scalable. Now compare that to fulfillment. To build a reliable network, you need massive capital expenditures. CapEx. You need to lease millions of square feet of warehouse space. You need thousands of hourly workers. You're managing fleets, fuel costs, real-time inventory. It's a completely different world.
And margins are razor thin.
Thin margins, fierce competition, and the sheer capital burn rate to build it fast enough, it was devastating their balance sheet.
Which brings us to the market panic. That astonishing decline during the 2022 bear market, the stock fell by as much as 87% from its peak.
Yeah.
That's not a correction. That's a crisis of confidence. Well, wait, let me challenge that for a second. If the stock fell 87%, wiping out all that value, how can we be so sure the core software business wasn't also fundamentally harmed? Doesn't a market reaction that severe suggest they broke something essential?
That is a fair challenge, and it really gets to the heart of this deep dive. The market reaction was genuine panic, yes. But the panic was aimed at the management team's judgment.
Not the product itself.
Not the product. It was about capital allocation.
Yeah.
Investors were basically screaming, we love the software, but we do not trust you to spend billions of our dollars on warehouses.
So the merchants didn't leave.
The merchant base didn't abandon the software. The investors abandoned the stock because of the colossal expense. The business was sound, but the strategy was deeply flawed.
And that distinction, a strategy flaw versus a business flaw, that's everything.
Yeah.
So when did the light bulb go on for management? When did they realize this was a failure, and what was the turning point?
Well, the bear market started to ease up in early 2023, which helped. But the critical shift was internal. They looked at the numbers and realized the capital needed to build that fulfillment network to scale was just, it wasn't sustainable.
It was killing their financials.
It was devastating them.
Yeah.
They saw they couldn't bear the cost without sacrificing profitability, without sacrificing the very identity that made them so successful in the first place.
The value of admitting a mistake that big, that fast, I mean, you can't overstate it in business. So what was the specific action they took? How did they remove this thing?
They executed a complete, decisive exit. In June of 2023, Shopify sold the entire logistics network they'd built and acquired. They sold it to Flexport.
So it wasn't a slow phase out.
No, it was a clean break, a surgical removal.
And what was the immediate benefit of that?
Oh, it was seismic. First, it stopped the massive cash burn instantly. Second, it let them immediately pivot back to their core competency, high-margin software.
Back to their identity.
Exactly. By shedding that asset-heavy burden, they regained their identity as a tech provider. They kept the merchant ecosystem, they kept the software moat, but they got rid of the operational headache and the huge CapEx.
So they corrected the course before that detour became fatal. They went back to being a pure software company that just integrates with partners like Flexport for the physical stuff.
That's it. They went back to being what the market valued them as in the first place.
Yeah.
And the stock's performance since that pivot, it reflects that renewed confidence.
Okay, now that we've established the anomaly, that perfect storm of a bear market and a costly detour, we need to put the volatility in context. An 87% drop still sounds terrifying. It makes you worry about the next one.
It should sound terrifying. But the context here is absolutely crucial. If you look at the company's entire history, more than a decade, the 2022 collapse is the only sustained and deep pullback the stock has ever had.
You mean before 2022, there were no big dips?
Oh, there were dips, but they were different. Totally different in nature. In every other case over the previous decade, the sell-offs were shallow, maybe 20% to 30%.
And they recovered quickly.
They recovered that ground within a few months, usually. often just in time for the next earnings report to show accelerating growth. The 2022 event, where the dip was near total and lasted over a year, that was an aberration.
Caused by that specific mix of macro fear and a micro operational error.
You've got it.
So the extreme volatility we saw in that 5-year window was an anomaly. It was driven by a rare, serious mistake, not the normal state of affairs for the stock.
That's the key takeaway for the outlook. The bullish argument is pretty simple now. The costly, capital-intensive distraction is gone, the company is leaner, more focused on profits, and its revenue growth is still chugging along.
So to summarize the whole narrative for you, the listener, despite the absolutely brutal experience for that 5-year shareholder who dealt with that rare combination of macro pressure and the self-inflicted fulfillment wound, those moments aren't really indicative of Shopify's long-term structure.
That's right. The overall story is still one of massive outperformance over almost any other time period you can pick. By pivoting back to what they do best, the expectation now is that its outperformance will continue as revenue and profits grow sustainably.
Unburdened by logistics.
Exactly. Unburdened by thin margins and immense capex.
So to wrap this all up, the key takeaways for you are, well, they're multifaceted. You see the dramatic difference between long-term and short-term returns. You understand the profound cost of a big strategic deviation.
In terms of market value and investor confidence.
And maybe most importantly, you see the immense power of rapidly admitting and correcting a multi-billion-dollar mistake.
What really stands out to me here is how this whole saga teaches us to critically analyze corporate strategy. It's a powerful lesson in distinguishing between, temporary market turbulence and a true fundamental weakness in a company's core business. Shopify proved its core was sound. The weakness was just a costly tangent.
A tangent that management had the courage to cut.
And fast.
Which leaves us with this final provocative thought for you to consider. We saw Shopify recover because they pivoted so quickly back to software, selling that network in June 2023. That speed was critical. So, what signs should investors look for in other businesses to know when a big strategic deviation, a costly acquisition, a misguided expansion is fixable versus fatal?
Look at the internal indicators. If a company announces a costly new strategy and then takes years to hit milestones, if they keep shifting the goalposts, that's a deep red flag.
It's about the timeline. It's the speed. Shopify acknowledging the failure and selling the assets within, 18 months of the strategy really ramping up, that's the metric you should look for. The quicker the pivot back to core strengths after admitting an error, the safer the underlying investment probably is.
Excellent point. Something to mull over until our next deep dive. Thanks for joining us.